Hello viewers and welcome to the channel. My name is Shannon Rifkin. Today we'll be discussing Fortescue, and after posting a net profit after tax of over US $10 billion, is Fortescue Metals a buy? So chart here, Fortescue since the beginning of 2020. I like to use that date range to show the initial impacts of the pandemic, which we saw. Like everything, the initial worst case fear was, and this was of course before government started to really spend on stimulus, fear was that global demand would across the board would fall off a cliff, and I think we saw Fortescue get well below $10 at one point. Then, as governments stimulated in a big way, China in particular, which got a handle of it on its COVID situation a lot quicker than other countries as well, started to spend big on infrastructure. We started to see, obviously, at the same time, real supply issues out of Brazil because of their COVID situation, and then you saw iron ore prices tick up very, very aggressively. And this rode that wave, and it got into an interesting point here as well, where Fortescue, which had long traded a little bit of you'd almost consider a bit of a discount to the big peers like Rio and BHP, at least its iron ore operations, because its product was lower quality, and it typically sold its product at a bigger discount to the iron ore price than BHP and Rio's high quality product. As they start to improve the quality of its product and get a lower discount, it started to outperform Rio as its margins improve quicker. Same time, it got itself down onto, and I think is now at the bottom of the cost curve and produces iron ore at the lowest cost in the Pilbara, or certainly at least in line with BHP. All the way up here, when we saw iron ore prices up around $230 a ton, before we've seen a pretty significant sell-off in iron ore prices down to about $145 a ton at the time of this video. And the picture is now, after another huge result, reporting in Aussie dollars about a net profit after tax of about 15 or $16 billion, paying another huge dividend of over $2 per share, all compared to a share price of a little over $20 and a market cap of around $60. Does this look cheap? Just looking through some of the numbers, mentioned that they have the industry-leading cost of production of US $13.93 per wet metric ton. This obviously there's some extra shipping and all that sort of stuff in there. It's not the final cost of it, but you're talking about compared to $140 a ton at the moment, and you can see how incredible the margins are in iron ore at the moment. Fortescue's obviously flying as well. It's producing at record levels, and so that it is really capitalizing as much as possible on those incredible margins it's seeing. And this, of course, is the average revenue it saw in FY21, which is still, which is roughly about the level we're at now. So, if we saw that iron ore price stabilize, and assuming no increase in production and shipments, we can kind of see exactly what the picture is going to be on its profitability. Okay, and yeah, this is the raw numbers under. We've seen incredible revenue numbers, 74% increase because of those higher iron ore prices. Margins, as I said, are absolutely astronomically high. Underlying EBITDA of over 20 billion, probably actually closer to 25 billion Australian dollars, and that net profit after tax of US $10.3 billion. So earnings per share in Aussie dollars of $4.48, which is interesting to see because of course we're sitting on on a Fortescue price of about $20. So where to from here? I've got one other one. This talks to that fully franked final dividend, showing the total dividends $3.58. I'll get my calculator out, but $3.58 including franking is about $5.10. So you're looking about, over the last year, about a 20% dividend yield, which and if you look at that, it's only about a 50 to 80% payout ratio they have. At the moment, of course, they're now spending 10% per year on their Fortescue Future Industries, which is going to be looking at green hydrogen as part of a big clean future for iron ore and steel production. And where to from here? Look, as I mentioned before, the iron ore price that was realized last financial year was, let's say, roughly around where we are now. So we kind of know exactly what sort of profit we're going to be looking at, assuming the price doesn't move. Of course, most analysts' expectations have a big range of predictions for where the iron ore price is going. My main concern about the iron ore price is, of course, that stimulus is eventually going to come off the boil. We've started to see, certainly on a monetary basis, talk of tapering, these unprecedented levels of quantitative easing in the US and Australia, etc., etc. But on a fiscal basis as well, there'll come a point at which the economies have recovered. They don't need the kind of life support behind it. I'm not suggesting this is tomorrow, but this is certainly over the next few years. And what will that mean for the outlook for iron ore or demand for steel once those stimulus taps have been turned off? And combining that with the fact that the supply picture out of Brazil has changed, of course, as the pandemic's evolved. As we see, of course, supply levels back to normal. And that demand-supply equilibrium possibly achieved at a lower price. Are we? There's no point saying that I think Fortescue is really cheap at these levels if iron ore prices drop from the $140 they're at now to $80 next year. So I feel that's where we are right now. There's no doubt in my mind that Fortescue is really cheap. It's, as I said, it's paying about a 20% dividend yield right now. And a PE multiple of something crazy like 5 times. It's not a sustainable price unless you're of the view that iron ore prices are going to go lower. That's what analysts are factoring in. My view is that iron ore prices are going to go lower, but probably not as quickly as some analysts have those expectations. And with that in mind, then I think probably as a Fortescue shareholder, you could hold for a few more years, continue to reap this incredible dividend flow, and still get out, when that cycle looks like it might turn, with good overall profits. So my feel is that Fortescue at these levels remains decent buying. Certainly not as good buying as 6 months ago, when we were still earlier in this pandemic, earlier in the government stimulus story. But of course, in the meantime, we received a lot of dividends, and I think that'll continue. And I should say as well, I wouldn't bet against Twiggy Forrest for his vision for its green hydrogen picture. It's 10% of the business, 20% of profits being spent on that now, and one day I wouldn't be surprised if, like he surprised everyone with his iron ore vision, that he does the same with his green hydrogen vision, and this will be another big part of the Fortescue business in time. Anyway, that's it. Thank you for tuning in. If you like the video, click like and subscribe, and I'll be back to you next week.